Well, welcome everyone. We'll start here in about 15 seconds or so, but looking forward to sharing some information with you here on this today's webinar. This is a specially created webinar just to go over some of the most recent tax law changes that could impact you as well as most of our clients. We're going to go through a couple of examples that I think will be somewhat informative. Obviously, everyone's situation is a little different. So you can just assume that whatever I'm going to illustrate to you, it may just get the thought process started as you start thinking about your own personal situation and how you might be able to benefit from this. So I'm going to go through a case study that I think is somewhat broad enough that hopefully hits on a number of different topics that you would be interested in. And just to give you a quick introduction, so I'm the CEO of a CPA firm, Providence CPAs. We have a division named Physician Tax Solutions. Our client base is scattered all over the United States. We have about 70% of our client base that are physicians, what we describe as entrepreneurial physicians. So these are generally physicians who have a little bit of 1099 income, or they have all 1099 income, or they have other investments such as real estate and or business interests, so that they have some level of complexity, and also for the most part business income that we can help advise them on how to what kind of tax planning is available. My career goes back over 35 years. As a CPA, I went back to law school, have a tax law degree. What our practice focuses on is the proactive tax planning that I think a lot of our higher income, higher net worth clients are lacking from the traditional accounting firm. So we spend a little bit more than half of our year focused on the tax planning piece. And then the rest of the year is on the compliance piece, which is typically what an accounting firm deals with. Quite frankly, how we view a tax return is really the scorecard to tell us how well we're doing the tax planning year after year. So anyway, that's a little bit about us. And I also have Angie O'Day on the call. She is our client success manager, and I'll introduce her, or I'll mention her again at the end of the webinar if anyone is interested in reaching out to schedule a free introductory call to find out more about how we might be able to help you. Just before we get started, I just want to let you know that everything I'm going to talk about is within what I call the four corners of the tax law. We don't need to push the envelope. A lot of the challenge with tax planning is just knowing what the tax law allows, and then just following the pretty clear guidance that the IRS and the government provides, just to dot the I's and cross the T's. So a lot of it is just knowing what to be looking for. The benefit of sometimes having those advanced degrees or those extra designations is much like as a physician, it just helps you better diagnose your patient or your client with that education, and obviously having years of experience seeing a variety of different situations also helps with that. So anyway, everything we're going to talk about is above board. If there's a lot of additional research and resources that support each of these recommendations I'll talk about. We won't have time to go into that type of detail here. So this is really just going to be a 30,000-foot view, but it's to give you some ideas of what's out there. So the agenda for what I'm planning to talk about today, and hopefully this will be an interactive conversation with answering questions that you have. First question, obviously, is why would somebody want to do tax planning? What's in it for you, and what is it? I'm going to introduce what I describe as as a fairly straightforward 3-step process on how to reduce taxes. And then I'm going to, after I sprinkle the pixie dust of tax strategies on you, we'll look at a case study that hopefully you can identify with, especially if you have some 1099 income or really any outside business or investment income. Also allows you to do additional tax planning. And then if you'd like to have a further conversation, we'll talk about next steps and how we might be able to connect. So anyway, first question is, why do we want to do tax planning? I start with a couple of quotes. A famous quote from a Judge Learned Hand. Anyway, the quote says, anyone may arrange his affairs so that his taxes shall be as low as possible. He is not bound to choose that pattern which best pays the treasury. There is not even a patriotic duty to increase one's taxes. Over and over again, the courts have said that there is nothing sinister in so arranging affairs as to keep taxes as low as possible. Everyone does it, rich and poor alike, and all do right. For nobody owes any public duty to pay more than the law demands. So I think that really sets the tone. A lot of times, and I know, working with physicians, and I come from the same approach. We're very concerned about taking risks, especially ones that we're in uncharted territories where we don't know a lot about. So this is again why just like how a patient goes to a physician to be taken care of with their health care, you need to be in good hands with somebody who can walk you through what you can and can't do under the tax law. Another quote I like to talk about is from Ron Paul, who, as you know, is also a medical doctor, former U.S. congressman. He said, one thing is clear, the founding fathers never intended a nation where citizens would pay nearly half of everything they earn in the government. And Jordan can probably vouch for this, but when you live in states like New York, it sometimes is often more than 50%, and states like California. So that was probably more of a statement on what an average person pays. But then when you take into account all the other taxes, which I think I once heard that Congress, I think it was Will Rogers that said Congress never met a tax they didn't like. But now we have state taxes, now we have sales tax on top, we have property tax. So, and then if you are too successful at accumulating your wealth, you're going to have an estate tax, when you die. So anyway, taxes are unfortunately an inevitable part of our life and our society. But income taxes are where you have a lot of choices on how much you pay if you have the right kind of circumstances. And then I'll leave with one other quote. I'm in favor. This is Milton Friedman, who is an economist, statistician, and a Nobel Peace Prize winner. But he once said, "I'm in favor of cutting taxes under any circumstances and for any excuse, for any reason, whenever it's possible." Now, hopefully that meant, obviously for legal reasons, not illegal ones. But let me tell you a couple of observations after, now almost 40 years of being a CPA and working with, high income clients on, helping them legally reduce their taxes. First of all, the tax laws aren't fair. They're written to favor certain people. Usually those people are the ones that have, the strongest lobbies with Congress. Unfortunately, individual W-2 employees are not a very strong lobby with Congress, and as a result of that, they tend to get the heaviest tax burden. Not only can they not write things off that other taxpayers can, who have the right type of circumstances, but they also are subject to an ever increasing amount of FICA and Medicare tax, as if they're ever going to receive any of that money back when they retire. So W-2 employees, and it's a very unfair tax structure that that W-2 employees, if that's the only type of income you have, to really be able to reduce your taxes. Other business owners, investors, primarily real estate, those are highly favored under the tax law, and a significant amount of the tax law is devoted to those type of individuals or taxpayers. The other observation is, just do what the government wants you to do. I don't recommend, taking on the IRS. It's actually easy just to follow the rules. You just need to know what the rules are in order to pay less tax. Also, it's not so much how how much you make that, I'm sorry, it's not how much you make that determines how much tax you'll pay. It's how you make that income that really matters. Like I mentioned, W-2 income is penalized, but if you have even a small amount of 1099 income, that's at least a starting point to be able to start taking advantage of the tax laws. Tax laws are constantly changing and getting increasingly complex. I can't remember how many pages exactly the Internal Revenue Code was when I was back in college. I think it was under 1,000 pages, but now just the Internal Revenue Code. So this is just the primary statute of that Congress passes is now over 2,600 pages long. However, that's not all of the tax law. You also have the Treasury regulation, so they're interpreting what the Internal Revenue Code says and providing further details. You also have the IRS rulings and publications that they have. That's up to 9,000 pages, assuming somebody's going to print it, which nowadays I don't think anybody does. That's over 4 million words. And then if you add the case law on top of that, which interprets the regulations and the rulings and the Internal Revenue Code, that's over 70,000 pages. So as you can imagine, there's no human being alive that maybe artificial intelligence will someday, but there's no human being alive today that can really understand all of the tax law. One of the reasons we chose to specialize with high income physicians is because it allows us to at least focus our attention on just the applicable provisions that that we need to know about to be able to help our those specific clients. We don't need to know everything about construction taxes or technology taxes or those type of things. I mean, we do have a couple of clients in those areas, but with most of our clients being physicians, it allows us to really understand the laws that apply to them. If you look at a graph on how complex the tax law has become over the last several decades, all the way back to when taxes were first created in 1916, you can see this incredibly upward, almost a geometric growth curve of how much complexity you have, and you don't see any downward trend. So unfortunately, I think we're at least in our lifetimes, unless something significant happens, I think it's only going to get more complex, which again, requires even more importance that you work with people who understand what the law allows you to do and helps you and navigates you through what the rules are. The good news is I look at the tax code as a series of green lights, yellow lights, and red lights. Red lights obviously are the things you can't do, or you'll get in trouble. Yellow lights are the ones that you don't want to push the envelope too far. Green lights are what Congress has said, hey, if you follow these rules, here's all these ways that you can minimize your taxes. 99% of that of the tax law is really about green lights. It's just knowing what those are. So and then the other thing I'd like to just make sure everyone is aware of, because this is not always a common fact, is that there's a difference in what I think are some people call a tax accountant and a tax strategist. So if we look at a tax preparer, if we look at the difference, and this will help you, to the extent that you are a candidate for working with a tax strategist to know what to look for. So, here's a couple of differences. Tax preparers, so that usually involves, there's usually three designations that allow you to sign a tax return on behalf of somebody else. You're either a CPA, which it's a dying breed. There's, I think, for every 4 CPAs retiring nowadays, there's only 1 entering the profession. So it is a shrinking designation, harder and harder, to find good CPAs. A lot of them are at the baby boom age, which is where I am. But anyway, you also have enrolled agents, which are people that take a fairly significant amount of testing through the IRS to learn how to sign and prepare tax returns. And then if you have a law degree, you can also, or if you practice law, you can also sign someone's tax return for compensation. However, all of the training that tax preparers go through, it's mostly around making sure that they prepare and timely file your tax return. So that is, and if you look at a CPA or an enrolled agent, they're a lot like having a really good car mechanic. They know how to fix things under the hood, when things go wrong. However, a tax strategist is somebody who's really focused because they understand what the tax law allows. They're focused on reducing whatever that tax burden is. So kind of like, diagnosing a patient, the tax strategist is going to come in and look at your situation and hopefully come up with, several recommendations on how to reduce your tax liability. They use deductions, credits, tax credits, and just pushing income in and out of different years to lower your tax liability. Tax preparers, because of the type of business they're in, they're generally reactive. They're looking through the rear view mirror of where a client's been, and just recording history to make sure and making sure that that the tax returns are prepared for the prior year. With a tax strategist, you're hopefully looking or working with somebody who's looking through the windshield of where you hope to go or where you are currently, so that they can engage in tax planning throughout the year. Normally, it's going to be heavily weighted toward the end of the year, but since the beginning of the year, it's hard to predict necessarily how a year is going to go. But anyway, the one is reactive, the other is proactive. Tax preparers are highly trained, and as a CPA, I know this because I've been through this. I go through this training. You're trying to minimize mistakes to make sure that the tax return is accurate. With tax strategy, your education is all around looking through the lens of how can we improve this situation. Generally, that's going to be working with somebody who has some type of an advanced degree or advanced training. Unfortunately, I've been my inferiority complex is such that I've early in my career, I just tried to get as much education and training as I could, so that I could put myself in a position to be able to to best serve my clients. So anyway, look for those advanced degrees and that advanced training and years of experience. So again, I'm biased toward the back half of my career, but don't generally somebody just fresh out of school or with just a couple of years experience is just not going to have the maturity level and the world experience to be able to look at those opportunities and to know how to advise you. Tax preparers it's all about accuracy. They hyper focus on just making sure they've got the right information on the tax return. Tax strategists, their main focus is how much tax can we save? What are all the options? Tax preparers, make sure you follow the law. That's very important. And then tax strategists help you leverage the tax law. So, what do you have going on, that we haven't yet, thought about that we might be able to improve your tax situation. Tax preparers rarely know because they're not educated or trained to have to know what the full extent of the tax law is. Tax strategists, that almost as an insane hobby, most tax strategists, spend their spare time, studying, the updates in the tax law. That's probably why they're not the most not the best people to invite to a social party, but usually those are the people that they spend their extra time really trying to understand what the law says and how to interpret it. Tax preparers may cause you to miss out on significant tax savings just because they don't have the capacity or the time. I don't know, for those of you on this call, if the last time your accountant came to you without you asking and came up with an idea to help you save taxes. Usually it's, they haven't yet done that or they've never done it. And that's usually just because they don't really have the time to do that. They're so busy just getting the returns done. A tax strategist, is going to be able to incorporate your long-term financial goals to the extent that you want to, share those with the tax strategist. Tax preparers, one thing I like to look at is always, focus on the return on investment whenever you're hiring any kind of consultant or advisor. With a tax preparer, it's kind of like mowing your yard. They're just doing something that, to save you the time and effort, to do it yourself, but they're really not creating any additional value. With a tax strategist, they ought to be able to show you, numerically and quantify, what is the overall, return on your investment that you're getting. Obviously, it's going to require a greater investment to have somebody do that type of tax planning, but they ought to be able to show you what that return on investment is. I would say, it should be a minimum of 5 times whatever they charge, and In a lot of cases that we work with, it's sometimes 20 to 30 times return on investment. Anyway, that is, those are the differences, I would say, between that what a preparer does and a strategist. It's a strategist, and if I were to say, where's the break point? Obviously, people at any tax bracket usually don't like to pay any more taxes than they have to. But I would say that the cost, the break even, where it really starts making sense, is if you're in that 35% or greater federal tax bracket. Obviously, if you live in a high tax state like New York, like California, it makes it even more, more valuable. In an ideal world, you'd want both. And ideally, you want them both together, as in the same firm, so that they can coordinate the efforts between getting the tax planning done, making sure that everything's communicated over to the team that's going to be preparing those returns. But the ideal is to have both. We have encountered situations where people like to keep their tax return preparer around. We find that we spend as much time, if not more, educating the tax preparer on the tax strategies than for us just to do the work ourselves. But it is possible sometimes in rare situations that you can have two different people doing those two roles. But in an ideal world situation, it would be under one roof. Let me move from that some of those observations to this three-step process that I think would just help you simplify how we approach tax planning. First thing we want to do is maximize deductions. So first and foremost, we're talking about deductions that are basically money that you are already spending. We just want to make sure that you're just not leaving any money on the table, and you're spending money on something, but you're just not looking at it in through a business lens yet. And if we have the right type of structure and the right and a business purpose, our first goal is to turn things that you might already be spending money on, or that you can spend money on, but it stays in your pocket. We want to take advantage of those deductions. So that's the first step. Second is, if you're 1099 or if you own a business, we want to make sure you've got the right type of entity structure, because if you don't have the right type of entity structure, it could be a drag on how effective your tax planning is. And then the third is there are several situations where obviously not everything's a boilerplate for everybody, but there's some additional strategies that may be unique to your situation. So I'm going to go through a handful of slides just on each one of these. What are these what I call low-hanging fruit deductions that are out there? I'll talk a little bit about the home office, travel expenses, how you can make sure you maximize those, meal expenses, hiring children and grandparents, possibly, making sure that you're aware of the things that you can write off, depreciate, as well as this additional deduction that not a lot of physicians are eligible for because of the limitations, but it's the qualified business income deduction. Some of you who have side businesses that aren't considered service businesses, you can still, even though you have income as a physician, you might still be able to take advantage of the QBI deduction, or you might have a spouse or a partner who can take advantage of that. I'll talk a little bit about vehicle expenses, healthcare insurance, fringe benefits. That's a popular one. Medical expense reimbursement plan, accountable plans, and then retirement plans. We won't obviously have time in this webinar to go over a lot of detail, but most of this is just here to whet your appetite to know, so that you can at least start looking into these deductions and seeing how each one of them may be able to help you. So let's talk about the home office. So there's several ways to calculate the home office. Not a lot of people know, how to make sure you got the best one. Let me make it fairly simple. If you have a home office that you can you have 1099 income that you base out of that home office, the best way to maximize your home office deduction is take your total square footage of your home, but subtract the common space from that. So things like the hallway, things like the dining room, the kitchen, the living room, the den, all of those things are shared by the office as well as you as the homeowner. And you shouldn't be penalized if you have to include the common space in the denominator of that of that fraction. So first thing you do is you start with your home office, subtract out the common space. Then your denominator or your numerator is the office space, your square footage of your office space. That's going to result in a much higher, more significant fraction to multiply all your home expenses by if you just took the total square footage of your house and divided that into your the numerator. You also, if you have a business vehicle, which all of you would, if you have a 1099 income, you also include the square footage of your garage along with your home office. So if you have a 2-car garage and you have a business vehicle in it, at least half of your garage square footage is also going to be included in that numerator. Anyway, just a little tip on maximizing home office. Travel expenses, this is potentially a big one, because a lot of our clients who are 1099, they work long shifts when they do work at the hospital, especially if you're an ER doctor and you're working back to back or shifts that are real close together. But under the tax law, if you from the moment you leave your home to the moment you get back to your home, if that time period is more than 12 hours, you're considered traveling overnight. And what that means is that every city in the United States has a per diem allowance allowed under the tax law that you can choose to deduct in lieu of actually deducting your actual out-of-pocket expenses. Anyway, so just keep in mind that if you do work long shifts and including commuting or driving back and forth, that's more than 12 hours, that there's a very generous, potentially per diem allowance. When it comes to meals, if you don't do the per diem allowance, just be mindful that there are certain deductions that are for meals that, for example, if you're entertaining another doctor or patient, obviously that may not happen that much, but there's a 50% limitation. But if you provide food for your staff in general, that's 100% deductible. And then certain expenses, extravagant expenses, entertainment, unfortunately, a couple of years ago, for example, you can't take anyone to a basketball game and deduct that cost as an entertainment expense. Used to be able to do that. So anyway, that's meal expenses. Putting kids and grandparents on payroll. This is a fairly well-known strategy, but just don't be. In 40 years, I've never had a single client ever get audited for what they paid their kids. There's actually a well-known tax court case that the taxpayer won that allowed this family business to employ a 7-year-old child and pay them a $50,000 salary, and that was considered reasonable. So don't worry too much about how much you pay your kids. Usually, what we recommend is have them do an age-specific responsibilities. And their standard deduction is about this year is $15,750. If you're comfortable putting your children on the salary for that amount, that is that'll be a business deduction for you. It's not going to be they don't pay any federal income tax as long as they don't have any other income as long as their income is under that amount. The other important thing is that you can't pay them out of your S corporation or a C corporation, but a minor child. If you first pay yourself, the way we do it is we give the client a 1099 as a consultant out of their S corporation equal to whatever the amount that they're going to pay their kids, and then the client through their Schedule C then employs their children. If they're under the age of 18. There's an exception to the FICA and Medicare tax rules where you do not have to pay FICA and Medicare tax on children that you employ through a Schedule C. Same rule applies to Schedule E. So if you have rental property that's kicking off positive income, you can also employ them through the rental activity as well. So just keep that in mind when you're hiring children. With grandparents, a lot of times it's if you're providing financial support for your parents, you might as well explore whether or not it makes sense to put them on payroll. At least you'll get the deduction. Now, they would have to pay FICA and Medicare tax on their salaries, but still, when you do the cost analysis, if they're in such a low tax bracket and the only thing they have is FICA and Medicare tax, it still may make sense to put grandparents or parents on payroll, especially if you're already providing their financial support. Depreciation is a big one. With the big beautiful bill you might have heard about last month, that they brought that back with bonus depreciation. So now you can claim 100% depreciation on qualified equipment. We've always had Section 179, but there's some limitations with 179. Bonus depreciation generally does not have any limitations. So things like any kind of equipment that you buy when you equip your home office, all of the furniture, inventory, everything that you have in your home office, anything that you haven't written on your tax return in the first year that you have your home office. So that could possibly help. Also, your automobile, if you use it more than 50% for business, you can also claim bonus depreciation. If it's under 50% use, then you're stuck with straight line depreciation, but at least it's still a write-off. You have to take a couple of years to get the benefit of it. The QBI deduction, again, this does not apply to a lot of our clients, but it is good to know in case you don't. Either you're under the income limitation where it starts getting phased out, or if you have another side business that does not qualify as a specified service business, that you can also claim that 20%. It's just a free 20% deduction that Congress came up with, with the 2018 tax bill. So definitely want to make sure you consider it and take advantage of it if you can. Vehicle expenses, like I talked about, if you have a home office, 1099 income, or better yet, if you're an S corporation domiciled at your home address, every time you leave the house to go to work, that is not commuting miles, that's business miles. So you can rack up a whole lot more total business miles, meet that business use percentage of over 50% a lot easier, when you domicile your business at your home. There's two ways to do it. One is either taking the per diem, the per mile allowance right now, or this year it's 72.5 cents. You've fully depreciated your car and then it drops way down, or you can do your actual expenses. So add up all of your out-of-pocket expenses, insurance, gas, maintenance, and then add on depreciation and any interest that you might be paying on a finance vehicle. All of that multiplied by the business use percent then is the other option. And then just take and it's a year-to-year decision. Just take the greater of whichever one kicks off the greatest deduction. Healthcare insurance, if you are an S corporation and you do pay your own health insurance premiums, you can write that off on your S corporation tax return. You do need to include it back on your W-2. So there's a little bit of a reporting issue there, but just don't assume that you can't deduct your healthcare insurance if you are self-employed. You can and then you can take it as an above the line deduction on your tax return. Don't make the mistake of thinking that the only way you can get deducted is if you itemize your deductions and exceed the 10% threshold in order to itemize. The health insurance is an above the line deduction, or it can be deducted on the business tax return. Fringe benefits are one of my favorite. Also, a lot of our clients, you might need to have something other than an S corporation to take advantage of these. But a couple of these that may come up may be of benefit. Dependent care assistance. If you don't qualify for the dependent care assistance, you can have a dependent care flexible spending account. That's usually something that is an alternative when you're in when you're not eligible usually to take advantage of the dependent care credit. Group term life insurance. Not that $50,000 is a lot, but that. At least you can pay a little bit of your life insurance with tax deductible dollars. I don't have it here, but disability insurance is another big one. So disability insurance is also a business expense. I would recommend doing it a certain way. And the reason for that is that if you pay your disability insurance in the current year when it's due, if you became disabled and you deducted that, that insurance premium on your tax return, on your business tax return, if you became disabled during that year, you have to pick that disability income up as taxable income. However, if you pay that disability insurance out of your personal funds, and at the end of that term, when the next year policy is now due and payable, if you reimburse yourself out of your business for the prior year payment that you paid personally, now, and if you became disabled during that second period, you didn't deduct the premium yet because you hadn't yet reimbursed yourself. It's now tax-free money proceeds when you if you became disabled, not taxable. Just wait a year, just reimburse yourself when the year passes, and that's a way around that, having that disability proceeds. Knock on wood, hopefully that doesn't happen to anyone, but if it did, at least it wouldn't be taxable income. Medical expense reimbursement plan. This is just a easy, if you don't have a high deductible qualified or a HSA, this is another way for you to reimburse yourself for all of your out-of-pocket dental, medical, vision expenses for you and your family. There's a couple of different options here. Obviously, health savings accounts are one option, but they are max or capped at how much you can put into them. Keep in mind too, if you do have an HSA and you're healthy and you never use it, you can eventually roll that over to your IRA and just obviously take it out during retirement. So you don't have to spend it necessarily on health insurance or lose it, kind of like a flexible spending account is. Health savings accounts just grow with you and you can take those with you. Another lesser known health related savings account is what's called a 401h account. So usually these are tagged on to a defined benefit plan. But you can generally put in about a third of what you can put in a defined benefit plan in a 401h account. And that is just it's kind of like a 401k, it's just a separate account, but it is for your medical or your healthcare related expenses during retirement. And so as you can imagine, if you can put in a third of what you can normally put in a defined benefit plan, which is tens of thousands of dollars, if not $100,000 every year, that can accumulate to quite a significant amount that you're able to deduct on your tax return. If you use it during retirement for medical, it's tax-free money coming out. And one of the things that you can spend that 401h account on is the medical portion of an independent living apartment or home that you buy. So you can basically buy your part of your home that qualifies for a medical deduction during your retirement with 401h money. So it's a clever way to be able to put money away, for future healthcare related expenses, a lot more than you can do with an HSA. Accountable plan. So this is basically what your business or your S corporation is going to need to have to reimburse you for any out-of-pocket, vehicle expenses. If the vehicle is not owned by the business, travel expenses that you might incur, meals, home office. It's generally, you need to have an accountable plan. That it's just a document that just authorizes the business to reimburse you, but it is necessary in order to get that that tax deduction. And then we could have an entire webinar just on the retirement plans out there. I've listed the most popular ones here. Obviously, when you're 1099, you can take advantage of one or several of these. The one limitation you generally can't do is you can't contribute to what is referred to as a qualified plan. So those are profit sharing, 401k, 401h plans. You can't contribute to those plans and a SEP IRA in the same year. You can own both. You just can't contribute to both in the same year. But as far as how many other of those plans you can have, there generally aren't any other limitations. We have a lot of clients that also like something called a restricted property trust. It's a way to put in money into something that's about 70% tax deductible, but it does kick off tax-free income during retirement. So that obviously has a certain level of attraction. And then there's certain deferred comp plans that also allow you to deduct as much as 100% of the contribution going in, and some of those also have a tax-free treatment on the back end. So just know what all your options are when you're looking at it's an alphabet soup of retirement plans, but work with somebody who knows how to help you navigate through what the options are, especially if you're already covered under a plan where you work. If you have a W-2 job, you just want to make sure you're not running afoul of having the wrong type of plans or over contributing to to the plans. And then the second step that I want to talk about is just optimizing your ownership structure, your business structure. So if some of you are getting 1099 income and you're getting it as a Schedule C, it does not necessarily mean that you need to all of a sudden flip the switch to become an S corporation. And the reason for that is that if you have a W-2 job and you're over the FICA wage base, which now is $184,000, and you also have 1099 income, if you go and set up an S corporation and run that 1099 income through, and as you may know, as an S corporation, you're required to pay yourself a reasonable salary every year. Well, you're going to be forced to pay yourself a salary out of your S corporation. And unfortunately, under the payroll tax rules, you've got to withhold FICA and Medicare tax all the way up to that wage base all over again. And unfortunately, as an employer, you never get that half of that FICA tax that you're going to have to pay in, unnecessarily. You would get a credit for the employee portion of the FICA tax. You get that back as a credit, but just be careful. Just because you have a 1099 income, it doesn't always mean that being an S corporation is going to help you save taxes. You may end up having to pay more in FICA Medicare tax than you would have if you had just paid the 2.9% self-employment tax on your Schedule C income. Also, most of our clients, if not all of them, who have S corporations generally will have a C corporation. And the reason for that is there are certain fringe benefits that a C corporation can offer that an S corporation can't. So having the best of both worlds allows you to pick and choose which, where the deductions are the most valuable. Also keep in mind that C corporations, although they are double taxed, there are ways around that second tax, but C corporations are subject to a flat federal rate currently of 21%. Used to be 15%, now it's 21%. So if you're in a 35-37% federal bracket and you've already maxed out your retirement plan, but you're looking to save up money, to make an investment in rental properties or a private equity deal, you might consider shifting that extra money over to the C corporation. That may be an administrative service corporation or a management company of some kind. But you basically are going to save the delta between what your ordinary tax rate is and what that 21% rate is. So if you're in a 37% tax bracket, that's going to keep 16% of that money in your own pocket. So it may be having both entities is generally what we find is gives people the most number of options. And then I'll end on this second step with something that I use when we educate our clients on how to when they're maximizing their taxes, but we also want to be mindful that they've got estate planning at some point that they need to address, and then they carry around or they walk around with this huge bullseye on their chest, with liability in our litigious society. So I create this diagram. I call it the tax, estate, and asset protection trifecta. But it's a diagram that I use to illustrate how we want to keep your operating business where you get your 1099 income over on one side, protected, because that's the entity that might have some business risks that we want to isolate. That red line indicates, creating kind of a brick wall between, the wealth that you're going to create on the right and the income, the source of the income that you're going to have on the left. So I put a variety of different, entities over on the right. There's a variety of there's several different retirement plans. Some are better than others. And then depending on your level of aversion to risk, which mine is pretty high just because I've lived a long life and I've seen a lot of things happen, you may want to consider, an additional level of asset protection above and beyond just setting up a simple LLC. So I personally have, and I generally can help you navigate through, does it make sense? Are you at that point in your career and accumulating wealth that it makes sense to look at creating a more advanced level of estate asset protection planning, including looking at possibly another jurisdiction to set that trust and that business entity up. One of my favorite countries to set up a trust and an LLC is the country of Belize. The laws that are there, they're about 50 years old.
a defendant in their courts have never lost, a U.S. citizen. The laws were written by U.S. attorneys trying to protect their wealthy U.S. clients from creditors. And there's a couple of reasons why Belize is attractive. First of all, they don't recognize any foreign judgments. So if somebody went all the way through the judicial system in the U.S., all the way through appeals, and they still had that judgment, and now they're knocking on your door to collect, if they go to Belize, where they have to go because your assets are owned through a Belize trust or an LLC, the Belize court's not going to recognize that judgment. They got to bring that lawsuit all over again. And as you know, most lawsuits are brought by lawyers working on a contingency, so they haven't gotten paid. So that's usually going to chill, most, if not all, of the lawsuits from ever starting over again in Belize. Second benefit of Belize is whenever you file a lawsuit in Belize, unlike in the U.S., which costs a couple $100 to file a lawsuit, it's the lawyers that are expensive. But in Belize, you have to put up a deposit with the court equal to the greater of $50,000 or 50% of the alleged damages. So if you had a $5 million judgment in the U.S., somebody wants to bring that lawsuit in Belize, that plaintiff's got to put up a deposit with the court of $2.5 million in cash just to bring the lawsuit. Well, that's going to chill almost everybody else's lawsuit. So anyway, you look into Belize if that's of interest to you. There's a website down there called assetprotectiontraining.com. Rob Lambert is an expert in asset protection training, but he has a website that has a lot of materials on the topic. Anyway, the trifecta is something that we incorporate with all of our clients just to make sure that they're not only minimizing their taxes, they're also they have the right type of estate plan in place, given where they are in their life, and then they've protected themselves from these unwanted creditors and predators that are lurking out there at any time. And then the third step is just looking at some other options. Like I mentioned, you might want to consider that C corporation to provide some type of service, maybe back to your S corporation, or if you have rental properties or you have other outside businesses, it's a good way to bring the family members and kids into the family business by being able to engage them. Also, you can shift that income, like I mentioned, down to that 21% federal tax rate. Another very popular strategy, especially for our clients, is helping our clients reinsure a lot of the risks that they have through a privately owned insurance company. We do not advocate a micro captive, which there's two types of insurance companies out there. They're governed by two different subchapters of an Internal Revenue Code. But one is a micro captive that's been around since 1986. Unfortunately, the IRS has chosen to attack those over the last 20 years. They've lost most of their cases in the last several years, so they're probably going to come back in favor. However, the insurance company that we recommend is the other option. It's cleaner, but anyway, so that's what we recommend to our clients. And then we also recommend, because it gives the client the ability to really pay in quite a bit of money in the form of premium for risks that they don't otherwise have insurance for. But we recommend that they have their stock, if it's the right situation for them, to own their stock in that private insurance company inside of a self-directed Roth 401k or Roth IRA. So it's what some people call a tax unicorn, where a lot of times you don't see these exist, but you get a tax deduction basically in the form of a tax deductible business insurance deduction. But at the end of the year, if you don't file a claim against yourself, it's paid down as a dividend to your Roth IRA, and then you can invest it however you want. So it's just a unique way to really accumulate quite a bit of tax-free retirement money over your career. There's also what I would describe as leveraged charitable impact investments. Generally, these are some type of medical research that is out there raising capital from investors. They've partnered with generally a public hospital or a nonprofit, where they then donate that research to the public charity. Usually that results in a charitable deduction equal to the fair value of that product, which could be anywhere from 4 to 6 times what the investor invested. So when you do the math, you're getting a very significant charitable deduction on your tax return for a fairly low price of an investment. So that's usually something to look at, especially if you're in that top tax bracket and you've exhausted all the other tax planning. If you own non-passive real estate, one of the things you may want to look at is getting a cost segregation study, or if you own your own office that you rent to your practice, a cost segregation study allows you to get a cost engineer's report that will push some of those costs of that building down to the shorter lives. So if it's a commercial building, the default is 39 years, which that's going to take most people's lifetime to recover that on your tax return. But if you can get a cost segregation study and shift 30 or 40% of that cost of that building down to a 3, 5, 7, or 15-year life, all of those shorter lives qualify for bonus depreciation. So it puts you in a huge advantage to be able to then say, do I want to claim bonus depreciation on all of that in the first year, or do I want to spread it out over 3, 5, or 7 years, just to when your tax rate may be a little higher in those years. Anyway, cost segregation studies for those who could benefit, if they have real estate or non-passive real estate, would be another strategy. And then something that's really become popular over the last several years is because there's a lot of really good companies out there. I'd be careful of ones that don't have a strong track record, but investing in a working interest in oil and gas, a development well, not an exploratory well. So you're generally going to want to invest with somebody who's going in after the oil has been discovered, and comes in and then drills to develop out that leasehold improvement. Anyway, the working interest, the big part of the upfront cost of a working interest is for tangible and intangible drilling costs. Those also count for first year 100% bonus depreciation. So keep in mind that, and then a lot of the oil and gas properties that we come across are usually in the 25 to 35% annual cash over cash return. So they can be good cash investments, and you get that upfront write-off as well. So anyway, that is the some of the alternative investments out there. There's dozens others, but to this audience, I didn't want to go through all the ones that you might be that may be possible. I wanted to hit the ones that that are probably the most popular. But let's look at a case study real quick, just to show you what all this could help. So I have a fact situation here. John Sample, 42-year-old psychiatrist, his spouse Jane, 40-year-old part-time radiologist. They live in California, unfortunately, with their 3 children, ages 11 to 15. They have the following income. They've got John has W-2 income of about $750. They both have 1099 income from working locums. John of about $400,000, Jane $350,000. So you can see their total income adds up to about $1.5 million. They pay about $35,000 in property tax on their home. And they each put in what the max is for their solo 401ks this year, which is $72,000 each, and they file married. So you can see their hypothetical tax return there on the right. Actually, the names, I meant to change their names to Elijah and Serena. The backstory for that is a book I wrote. Those are the characters that I have in my book. So I forgot to change John and Jane's name to Elijah and Serena. So anyway, but if you look at the calculation on the right, you can see their taxable income. They get itemized deductions of $40,000, which is the new SALT limitation. Since the big beautiful bill, they get to deduct half of their self-employment tax. They get to deduct their contributions to their solo 401k plan. They're left with $1,392,000 of taxable income. That translates to a $400,000 federal tax bill. Their self-employment plus the FICA and Medicare tax that they're paying the one half of FICA and Medicare tax that they're paying on their salaries is $78,000. And then they're also subject to the Medicare surtax, which is a 0.9% tax on earned income over $250,000. So their total federal taxes are $490,000. California taxes are $126,000. So they're paying $616,000 in tax on that income. So what can we do with this with this fact situation? Obviously, we wouldn't recommend it with John, but I would recommend it with Jane, that she run her 1099 income through an S corporation. That's going to reduce down the amount of self-employment tax that she otherwise would pay if she can pay herself a reasonable salary. So I just listed some of the deductions here with some assumptions. So let's just say that they have a home office deduction they can claim $1,000 a month for. They rent their home back to their LLC for up to 14 days under the tax law. You don't have to count that as rental income, but yet it still counts as a business deduction. $1,000 a day for 14 is $14,000. They between the two of them, they work 130 shifts, 130 shifts of at least 12 hours each. So if you look at, and if they qualified for a, kind of a ballpark average per diem allowance of $145 a day, that gives them an extra $18,000 write-off. They put their kids on payroll, 3 kids at $15,750. That's another $47,000 of write-off. The fringe benefits, this would be their home gym, their which I forgot to mention, an athletic facility is also considered a fringe benefit. So if you can reimburse yourself for your home gym, a hot tub, a swimming pool, all those things count as athletic facilities, plus out-of-pocket medical and dental and vision expenses. Let's just assume that was $50,000 for the year. They also wanted to fund, in addition to their solo 401ks, a defined benefit contribution of $100,000. They liked the restricted property trust. They started that with $75,000. They pushed $50,000 over to their C corporation, just to shift that down to that lower 21% bracket. They also added the self-insurance option. They put $100,000 into that. They did the charitable impact, and just to conservatively, calculating that at a 4-to-1. Usually it's a little bit more than that, but assuming they only put in $50,000, that generates a $200,000 write-off. If they invest in an oil and gas interest, put $100,000 in, and 80% of it constituted tangible and intangible drilling costs. That's an $80,000 first year write-off. And then with Jane's S Corporation, putting her on reasonable salary, she would get to deduct the payroll taxes that she pays, plus she can make an election to pay her share of California income taxes as a business deduction, which gets around the SALT limitation of $40,000. So that adds up, and that adds another $61,000 in write-off. So just adding those together, altogether is about a $750,000 write-off. And you can see on the right, if you probably jumped ahead and looked at what that impact could be, that is over a $350,000 reduction in their tax liability, which is basically about a 58% haircut. Our average client, as we've been tracking them over the last 10 years, usually we hit around 59-60% reduction year over year when they come to us with a similar fact situation. This just happened to be real close to what our average is. So this case study may not include all of the different things that you're interested in, but you can easily start seeing, and especially when you look at the ones where your money is staying in your pocket, you just have to have the right structure with the right type of documentation to justify it. But that $359,000 of tax savings is going to help cash flow a lot of those retirement plan contributions. The $100,000 going to the defined benefit plan, the $75,000 into the restricted property trust, their insurance premium of $100,000, which is all of those things are dropping down into a retirement plan. So your net worth is basically increasing by $359,000 each year. So pretty significant when you individually they may not be significant, but when they add up, they generally are. So finishing the case study, let's talk about next steps. If I haven't already worn you out, and if you are interested in learning a little bit more, to the extent that you can tolerate that, Angie, why don't you talk about next steps if somebody would like to at least have a conversation with us?
Awesome, David.
And first of all, maybe talk a little bit about our process and the model that we've created, just so that people can understand how we work.
Yeah, absolutely. Take a breath and a drink of water. Thank you, David. Okay, so our process is pretty thorough. We start off with a strategic tax blueprint. So that's really the very first step where we partner with you, and we will do your situation appraisal, your needs assessments, and then all of the tax recommendations that David will prepare for you. And then if you love everything you see after your blueprint presentation, which usually is about 2 hours long, we will begin onboarding and implementation. So this is really how we get you settled into the firm with a lot of accounting, financial and business setup. We'll do a lot of data gathering. We also want to always go over roles and expectations so that we can ensure we have a really nice nice partnership with our clients, tax mitigation, financial oversight, and lastly, retirement strategies. And then we will wrap everything up with year-end tax planning. So as David said, we're very proactive looking ahead. So we always want to make sure we are reviewing your goals, adjusting them as we need throughout the year as far as your tax strategies go, and then reviewing your retirement planning. And then, you know, the most exciting part, seeing how much money you're saving on your taxes, which really puts the nice cherry on top here. And so our strategic wealth system model, this is really the core elements in which we work with clients. So starting off with tax minimization, which begins with the blueprint that I just mentioned. This is how we are going to get down in there and see how we can reduce all of your tax obligations, getting you to a level where you feel like you have control of your money. So when we have your tax planning buttoned up, you tend to feel more in control of what's happening. And then lastly, financial independence. This is really the apex of everything that we do. So if we are doing tax planning efficiently for you and proactively, you will get to financial independence sooner rather than later, which is something we all want in life. And then I always do want to highlight The Richest Doctor. So this is a really great, book that David wrote. It's very insightful, especially for those that are high income, 1099 income. So, if you meet with me in the future, I'd love to put one in your hands. And then I would always want to invite you to schedule a 30-minute introductory call with me. It is, of course, a nice, insightful way to kind of recap a bit on what we do. I'll review your current tax situation and kind of like the pain points that you have going on. And then we'll also dive into our process a little bit more deeply than we are here, so you can get a full understanding of how we can personalize those tax strategies and get you to that point of that financial independence piece.